Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Scroll through the comment section. I think there's a good comment or question here. It says, "Thank you, Andy, for openly sharing your own positions. As someone who is far from a full-time investor, it really helps to have a reduced list of stocks to investigate instead of being overwhelmed by the many, many choices in the commodities market. It was nice to see some of my picks, Paladin, EMX, appear on your list as well. For here's the question: for a small retail investor, sub $10,000 is what I think. Would you advise for or against picking a large variety of stocks? My personal feeling is that I'd rather own a few stocks, but really know the business well and be able to monitor them as opposed to having 30 or 40 eggs in my proverbial basket and only superficially understanding them. Do you choose this large variety of stocks because of risk management or because there's much opportunity that you want to have a stake in as many as possible?" Now, guys, I'm not like the pro portfolio setup. A lot of my approach, it deals with technical analysis. It's got to have good technicals, otherwise I won't do it at the beginning of the move. And a lot of it also hinges, because the technicals are the fundamentals. If it doesn't have the bounce, I'm not going to go into it. I'll probably just go into physical precious metals. So I'm a huge physical precious metals guy. Like I don't know if I can stress that enough. So a large portion of my net worth's in physical precious metals, and I swap those with the ratios. That has yielded me the best returns of probably of almost anything. I mean, some of these individual stocks net me a huge return, but I keep piling it all into physical precious metals because it's the lowest risk. At least that's the lowest risk that I perceive in the market. It is lower than anything. It is lower than cash. Yes, it's a little bit volatile, but the risk is lower than cash because cash all goes to zero at some point. It asymptotically approaches zero, and they all go to zero. So it's the lack of volatility in cash doesn't mean it's safe. You just lose all your money if you keep it in cash. So I store my wealth in physical precious metals, and that's kind of my viewpoint. Now, I know a lot of people they want all these stock picks, which makes sense. And I owned a lot of stocks in some of my more riskier portfolios. I take a mathematical approach, and it has nothing to do with knowing a company inside and out. You can know an exploration company inside and out, and they may not find anything. That is a risk. Now, some of these companies, the symmetry in it is so asymmetric where you can risk 100% of your money and have it go nowhere versus one that hits it huge and you get a 40 or 50 times your money. I'm spreading it across because if I take $10,000 and let's say there are 10 good potential uranium exploration companies and one of them can hit it big. And let's say the payout of that one is a 40 or 50 times your money. I'm just throwing numbers out there, all right? And I put in $1,000 in each. I hit the one and I get a 40 times. So that's $10,000 in total going into $40,000 if it's a 40 bagger from one position. So 1,000 goes to 40, but my entire 10,000 goes to 40,000 of that group if the other 9 do nothing. Now, if I hit 2 of them and one does 20 times and one does 40 times, that's $60,000 on a $10,000 investment. All I'm doing is just playing a mathematical game of risk reward and spreading my bets out. And I don't necessarily have to know absolutely everything. And you could know everything, and it's not going to help you in an exploration company per se. I mean, how do you know what they have down there? It's kind of just getting a little bit lucky. But if you spread out amongst all of them, the likelihood of 1 or 2 of these hitting is probably pretty high. So it's just a betting strategy. That's all I did on that. So it ends up being a lot more companies. And some of these, like the uranium, where these guys are developing mines and they're exploration companies, there's a lot of risk in those. So I spread my money out. So if any one of them goes to zero, or if something happens that it doesn't go as planned, I don't get killed. And I don't have the majority of my money in these companies. So I want to make sure that is well understood. I hold the bulk of my money in diversified mining companies that are paying dividends, and in royalty companies like Franco-Nevada, Wheaton Precious Metals, Royal Gold, Osisko Gold Royalty, Nova Royalty, which is a smaller guy, Teuton Resources, EMX Royalty. I hold the majority of my money in royalty companies because I don't want the input costs. Another thing that royalty companies do is you have a diversified basket of royalties. They themselves are diversified themselves, so the risk goes way down. And then I do own some of the mining companies. It's just not as much. Like I own a Discovery Silver, I own Metallic Minerals, but again, the bulk of my money is not in those companies. Those are the ones I'm swinging for the fences. Those are the ones I'm hoping that can find something and do quite well. They may not pan out. And if they go to zero or if they don't move, doesn't matter to me. It's a very small position size. I'm hoping that they can kill it and just absolutely, find something big and push my portfolio forward. But I'm not banking on it. It's not going to have a large impact if it doesn't do anything. And then the oil companies, that's probably where I took my largest chunk of risk at the best time I could, and that panned out very well. So I bought SM Energy, Centennial Resource Development. QEP was another one I got really low, but they got bought out by Fang, and I still own Fang. MCF, which is Contango, is now CRGY. Crescent Energy, I think is the name of it. And I own all those. And I did get pretty good stakes in them, and I've done pretty well. I got pretty lucky. I mean, sometimes the timing, you get it right, nailed down. And I did very well in my timing for uranium. Doesn't mean that these companies are gonna. I think they're gonna still do well. I think they're gonna do very well. And I know some people talked about Rick Rule saying that there's only a 2 or 3 times left, but that's probably in URNM itself. Some of the smaller ones, there's still very good potential in them. And the uranium price is still very low. No one knows where this is going to go. No one knows what the blow off top looks like. No one knows how much money's out there and is going to rotate into this. He doesn't know. No one knows. So I'm leaving my companies, my money in those uranium companies. I'm leaving it in oil. I think we're in a big commodity bull market, and I'm staying in it. No way am I getting out. If I had $10,000 or less than $10,000, I would do physical metals, but that's me. Or a royalty company, like royalty companies like Franco-Nevada or Wheaton Precious Metals, or some sort of company like that, because a lot of these companies, as time goes on, and this is my opinion here, I don't know if this is going to be a fact, I think more nationalization, higher taxes, more problems are going to present themselves. So I would go with physical precious metals because that's where the lowest risk, highest return is. And I'm a big physical precious metals guy, though. And then I would look at my swapping, my physical precious metals swapping scenarios to use that strategy to increase your ounces. And it doesn't mean that you put all your money and you swap all of your physical metals over. So let's say you've got a good holding in gold. And gold might do very well because it's a monetary metal. That might be the best, that may perform the best in conditions that are coming up. I don't know everything in the market conditions. So what I do is I hedge myself. Like I have gold, I have silver, which are both monetary metals, and then I've got platinum because of the ratio. And then I'm playing that entire mix. And if we have high rates of inflation, I think platinum will outperform. And I may swap it to silver because silver is the next one in the cycle to hit. And usually platinum outperforms in the beginning. And if it gets to like 120, 140, 150 ounces to 1 ounce So 1 ounce platinum gets 140 ounces of silver. I'll probably swap it to silver. The problem with silver, though, is when you get to a certain amount, you're going to be swapping and getting so many ounces, it's ridiculous to carry and store. I mean, if you're swapping, I'm just going to make up a number. Let's say eventually you start to swap 200 or 300 ounces of platinum. You know how much silver that is? Well, let's calculate it out. I mean, it starts getting a little bit ridiculous because, I mean, if you're swapping 25 ounces at a time times 140, you're going to have 3,500 ounces for every 140 ounces you swap. I mean, this is a lot of metal. And if you've got like 200 ounces, let's say, I mean, that's 28,000 ounces of silver that you have. And if that ratio were to go back to 40, now you have 700 ounces of platinum. That's what I want to hold, 700 ounces of platinum eventually, because that's real small and compact. It doesn't really take up much room. It's easy to store. It's not hard to carry. I mean, 700 ounces, I can carry that. That's like a monster box. That's no big deal. Monster box of platinum. Now, that's when you are rolling. You know you're rolling when you're carrying monster box of platinum around. That's the end goal for me, at least. Because they're easy to store, they're real compact, and that's a huge storage of in terms of wealth density. But I'm going to do whatever the ratios tell me. And I'll be honest, guys, I made a lot of money doing that. A lot. And I got lucky because I didn't know the ratios as well. I just knew, like, hey, this was cheap, I'm going to buy some. I did not know ratios back in 2004, 2005. I did not know what I was doing, but I got lucky. I bought palladium, I got lucky, and then I got a lot more connected, so to speak, with the ratios, and then I started doing my swaps. So I made a lot of money in palladium, and then swapped it into platinum. And that arguably, since they are of the same elemental configuration, basically, and same group and same everything, it can be considered a like-for-like exchange, and you pay no taxes on it if you use a certified person to do it. That is a possibility to do platinum and palladium. Just letting you know. And gold and silver also could be considered a like-for-like exchange. So you have to get with someone who can do that. But you guys have to talk to a tax advisor. You have to talk to those things and see if that qualifies for whatever you're doing. I'm not a tax specialist. That is not advice. I don't know. You're going to have to consult. It says not to own Kazakhstan is crazy in my opinion. I am an investor and speculate with 5% of my portfolio. KAZ pays a dividend and will pay even more. You can buy it on the LSE, and I don't know how a good way to buy it. I don't know London Stock Exchange. I'm over here in America. I have no good way of buying Kazakhstan outside of URNM because I think that's the largest holding in URNM. Regarding copper mines, be very, very careful of the communist direction that Chile's taking. You have a leftist Marxist president now who already said they will be raising taxes on miners a lot and stop new mine developments. Looks like Venezuela 10 years ago. Look what happened. My suggestion is to get out of the miners that have a major presence in Chile. And do not forget coal. Massive bull market. Thungala, Yancoal, SXC, and speculative Oracle Power are my bets. And yeah, that's really good advice. It is, or really good information, however you want to call it. And the problem that a lot of people have is they're going to take too much risk, and their companies aren't going to pan out the way they want them to. Just because the price of platinum goes up, or the price of something goes up, doesn't mean the company you're in will go up. There's all these other external risks and factors that are tied to that. And I'll be honest, I don't even really look at a lot of the small gold and silver companies. There's so many that I just kind of like, whatever. I mean, I have a couple, but it's very, very little portion of my portfolio. I'm huge into the physical precious metals. Last bull market, the mining companies did well in the beginning of the bull market, and then they did nothing afterwards. They did well from 2000 to 2004. And maybe I can pull that up real quick. And that's your ratio that you're looking at. And I'll show you exactly what I mean by them doing very well in the beginning versus later on. So now I was looking at some of these companies here. So I'm just waiting for this to load. It'd be XAU to gold would be a spot. Hit all. Get off the log because this is a ratio. Now, what happened was they did well from about 2000 to 2004-ish. 2003 here. Yeah, Jan 04. That's all it did. And then it went down against gold. Gold outperformed the XAU index over this time frame in that last bull market. So, I mean, you would have been better off buying physical metals than the actual miners. All it did was from 2000 to 2004 here. That was the outperformance. You would have been better off doing physical metals from 2006 all the way to 2011, which XAU declined against the physical metal of gold. Now, we're at very low levels here, and I'm hoping we can get a good bull market going in precious metals next. But it's not guaranteed. This ratio is low. It looks like it's turning, and it wants to move on up. And hopefully that's the case because I have a good amount in mining companies, in mutual funds. I have a diversified approach to hit it. The rest is in physical metals because I know the physical metals will track that movement. And with all the risks in this world, with taxes, mine closures, declining ore grades, all this junk, increased input costs, increased energy costs, an energy crisis, it's like, dude, just give me the physical metals. That's all. I'm good. You know, like I don't need to speculate too hard because the physical metals might end up being the best play of all of these plays, and it protects you against monetary problems. So I consider any stock mining company far higher risk than the physical metal. So I just want to make sure people understand that. Big physical metal holder, smaller holdings in speculative plays, and next is diversified mining, royalty companies, and then the rest is spread out amongst a bunch. That's how I'm playing it, guys. I'm not putting all my money in all that speculative stuff. If you guys like this content, give me a thumbs up. Questions below, guys, and comments if you have any. Thank you for listening. This is Finding Value.